Global interest rates and the driving inflation remained top of mind last week as the US March CPI figure served up somewhat of a surprise as inflation slowed to 5%, more than what was initially anticipated. However, core inflation accelerated slightly to 5.6%, which could complicate matters for the Federal Reserve. The minutes from the March decision was also made available last week, showing some division within the camp on whether the Fed has reached or is approaching a rate ceiling. The number of US jobless claims, which went up by 11,000, certainly supports the argument of the Fed reaching a turning point as this past year's hike cycle is starting to stretch the economy. Over in the UK, officials are also facing a mixed bag. The Bank of England's chief economist now believes the economy could see a positive demand shock as low levels of unemployment mean Brits have more to spend, adding to economic growth. And while true, this increased shopping spree could also add to inflationary pressures. Over in China, the country printed a slowing CPI to 0.7% for March year on year, bolstering the argument that the state has some wiggle room left for supportive policies. And on Monday, its central bank chose a wait and see approach, leaving rates unchanged at 2.75%. China also posted a surprise surge in exports in March of 14.8% year on year. The country is being closely monitored for any support it could lend to global economic recovery efforts, a task the IMF now warns is becoming increasingly more difficult. It slashed its global forecast last week and now pegs the GDP growth rate for 2023 to be at 2.8%, citing tight monetary conditions amid a risk environment due to the ongoing Russia-Ukraine conflict as the reasons for the gloomier outlook. South Africa was also not spared the axe, but for some, the IMF was just playing catch up. And in ETM's view, even the IMF's now anticipated growth rate of 0.1% for 2023 is still too optimistic, as we expect a contraction of 0.2% this year. And it's clear why, as sectors continue to bleed. Mining production performed even worse in February than expected, with production output falling 5% year on year, largely due to a drop in coal and diamond output. And as the sector plays a key role in the country's trade fundamentals, its continued poor performance will further erode the rand's resilience. Manufacturing, which has been in a downward spiral for years now, also took a further knock in February, slowing by 5.2% year on year. The decline in the manufacturing sector serves as a clear example that it may be time for the state to send its centrist policies off into the sunset and allow for more private players to take the lead in recovery efforts. And it's with this data in hand, Cyril Ramaphosa attempted to sell South Africa as an investment destination of choice again last week at the fifth investment conference. There was an announcement on the expansion of the e-visa system and a new country investment strategy, as well as receiving 1.5 trillion rand in pledges since 2018, with a new 2 trillion rand target now set for 2028. The keyword here is pledges. We will have to wait and see how many actually materialize. Ramaphosa's aspirations, however, face a tough climate, with investors seeking more than just political rhetoric to convince them to spend their money. They want proof of structural reforms to the economy, which is not uncalled for. Even the SARB governor, Lesetja Kganyago, made similar calls in a speech last week. However, on this point, Ramaphosa's speech unfortunately fell short. These calls also come against the backdrop of foreigners dumping both South African bonds and equities at a rapid pace over the last couple of months. This downward trajectory is being driven by the higher global interest rates, as well as the continued constraints facing business activity, with future earnings being questioned in the absence of new capital investments. On the geopolitical front, the German foreign minister paid a visit to Beijing this past week. The trip was used to clear the air on the EU stance on the Taiwan China matter after French President Macron's comments calling for the bloc to stay out of the fight. And speaking of which, tensions between the East Asian parties escalated last week, with China hosting one of its biggest military drills encircling Taiwan. Some, including Taiwanese officials, claim it's a sign of Beijing's readiness to launch an attack as it seeks to squash any attempt at the island's independence. Political commentator Ian Bremer provided a slightly less alarming take on the matter, saying a full-scale attack does not align with Chinese President Xi Jinping's recent efforts to position China as a mediator and collaborator on the world stage. And there's the fact that Taiwan produces 90% of the world's computer chips, which, if supply slows, could pose significant implications for both China and the US, leaving an immediate attack unlikely. Looking at the week ahead, and just for interest's sake, the trial involving the former Steinhoff CEO, Markus starts in Germany today. It's been more than 5 years since the company's collapse. As for data, local markets will look to March's CPI being released on Wednesday, with ETM expecting a slight slowdown from 7 to 6.9%. However, core inflation may remain sticky at 5.2% year on year. Retail performance will also be released on Wednesday and will provide some insight into how South African households are holding up in the harsh environment. We're expecting to see another contraction of 0.1% for February compared to the previous year. Also happening on Wednesday is the release of the Eurozone CPI for March, with a slightly cooler rate of 6.9% expected. This, along with a couple of other releases scheduled this week, will provide some insight into the bloc's economic outlook. Then on Friday, the PPI for April for both the US and UK will be released. Both are expected to remain in the neutral territory. Taking a look at the local currency, with talks of the US coming to the end of its rate cycle, the Rand gained some momentum during trade late last week. The outflows mentioned earlier, along with these somber economic conditions, however, leaves the local currency unable to really gain some meaningful ground. But the dollar could face further pressure should the data continue to surprise on the soft side, and it's giving the ZAR its best fighting chance to recover somewhat against the greenback. And while the 18 Rand to the dollar handle holds for now, it could very well be tested this week. That then the week that was and the week to come for the market.